Hey everybody, JD here, and welcome to the very first edition of the Fireside Trader. I am so excited to be here, super pumped up, and been thinking about this for a very long time, wanting to really get everything right, including this wonderful backdrop of the fire, obviously the ambiance here, and it really captures the mood of what we're trying to do here. The goal of this journey we are on is to help you build $1 million portfolio. Before I get into the details of that, though, let me just tell you briefly a little bit about myself. You can call me JD. Jamie Dlugosch is my full name. I've been in the financial industry for, going on 40 years now, believe it or not. Started in this business taking my Series 7 securities examination on October 17th, 1987. Wow. That was perfect timing because 2 days after I took that examination, for those followers and people that study market history, you know that the stock market crash happened on Monday, October 19th, 1987. And I guess that is fitting because for the entirety of my career, there have been these moments of chaos in the markets. My career, I always started in the mid-1990s. After I went to graduate school, I, long story short, ended up getting involved with a money management firm that also had this little investment newsletter business. Is something I really fell in love with and have been in love with the investment newsletter business ever since. At that time, I was trained to be a fundamental value analyst, did things entirely differently than how they are being done today, really following a number 5 to 6 very basic mathematical value metrics, things like price to earnings, price to sales, price to book value, et cetera, as a way to identify stocks that we believed could double in value in less than a decade. It turns out, and keep in mind, this is the mid-1990s, where the average holding period of the money manager I worked with at that time was 6+ years, which, looking back on that now, seems like an awful long time. Anyway, over the years of working with him and then also launching my own investment newsletter in 2002 called The Rational Investor, I was able to reduce that holding period time, identifying stocks, focusing on really one metric, and that metric being price to earnings growth ratio, or PEG. That allowed me to cut down the time of a value from 6 years down to 3 years. And so it began really the journey into what I now doing today with the Fireside Trader, which is to basically be in and out of the market intraday and taking advantage of inefficiencies in pricing caused by computer algorithms, human behavior, the Federal Reserve, whatever the variables are impacting daily moves in the market are really the things that I focus on and try to exploit on an intraday basis. And so what I'm going to do here over time, the trader, is to, again, really focus and hone in on building $1 million portfolio. And in doing that, we're going to be allocating capital intraday, exploiting opportunities in pursuit of returns that are fairly significant. And while that may imply taking a certain amount of risk, I'm going to be doing a series of videos explaining my own on risk, for example, that will, I think, explain why I do not believe you're taking any more risk with the intraday trading than you are with your current passive investment strategies, for example, in the markets today. I mean, it really is fantastic to think that the investor today, in my opinion, is being asked to take maximum risk for minimal returns. And one statistic that really blows my mind, according to the Federal Reserve, 20% of the population aged 50 or older has $0 saved for retirement, and or zero savings, period. It doesn't matter what those savings would be used for. It's savings that are really any sort of goal or objective. And so that person that is woefully behind in terms of building wealth, and you may have heard of something called the K-shaped economy. We are in an environment today where the wealthy are continuing to do very well, building wealth, and those at the bottom of the K are absolutely struggling. We have things like high inflation to deal with, interest rates on card debts, which, again, the lower parts of the economy have more debts and they're paying more interest on that debt. It really very difficult. So what I want to do here in the Fireside Trader is to be able to help you navigate markets with a very simple goal of whatever your starting amount of capital is, building that, as I said, through intraday trading opportunities. And I'll explain more in future episodes too as to exactly what we're going to be doing here. But suffice it to say, the goal here is to build a $1 million portfolio and doing it in a fairly short period of time. It doesn't take a lot. For example, if you allocated, say, $5,000 per intraday trade, and you generated on average a 10% rate of return, you're generating $500 of returns in that day of trading. Now, there are approximately 250 trading days in a given year, and again, 250 trading days averaging $500 per day in gains. That's on average. So that's winners and losers included. Of course, there are going to be days where in your trading account you're going to be losing money, but also other days where you're making a significant amount of money. So the balance of your gains ends up coming in right around 10%. If you do that, you're going to build wealth very, very quickly. And you're going to do it in a short period of time. Why? Because as you build up your bankroll, let's say you start by allocating $5,000 per trade. As you build up your success, then you can start allocating a greater amount to each intraday trade, right? So you can go from $5,000 to $10,000 to $20,000 per trade. Now, 10% of $20,000, and you're talking about $2,000 per day gained. Again, it just grows and grows, and now you're going to build your $1 million portfolio. About a decade ago, I was the guru on a newsletter product called the Millionaire Blueprint, and that's where it really just stuck in my mind, this idea of helping investors and traders like yourself build a $1 million portfolio. And the key ingredient that seems to be missing for most people is a system or strategy that can help them reach that objective of 10% per trade per day. It seems like it's something that, depending on your viewpoint, it may seem fantastical to be able to generate that kind of return. In my humble opinion, I don't think that's a far-fetched goal whatsoever. And I suppose it's a good time to remind folks that all trading does involve risk. Make sure you understand the risks and parameters of your trading in pursuit of these goals that is appropriate for you. Don't do anything stupid or crazy out there. Okay, so this is a bit of a long-winded introduction to the Fireside Trader. In this particular episode, I did want to go over a couple key topics that I thought were interesting. These are things that, about 5 years ago, I discovered that I had some autistic traits, and turns out I may be on the spectrum. Well, one of the reasons I'm on the spectrum is because I'm able to identify patterns that other folks do not see. And when it comes to investing and trading in the stock market, that tends that lens is being very good at aggregating all of the factors involved in determining market price and being able to understand where certain trends are occurring or not occurring. And in the current market environment, you're hearing a lot about artificial intelligence. That's key driver of market growth. I heard an interesting statistic recently that if you look at GDP growth in 2025, that's some 90% of our GDP growth is due to what's going on in AI. And so that was really what I wanted to discuss with you today here in the Fireside Trader in this episode, was not that we are in a bubble. I'm not going to opine on that. I do have some thoughts on whether we are in a bubble or not. I think talking about artificial intelligence in terms of being in a bubble is a disservice to really understanding what's going on out there, not only in the economy, but within the markets themselves as far as allocation of capital. The question we should be asking ourselves with respect to artificial intelligence really revolves around, is it appropriate to have such concentrated investment into one area? Now, I get that artificial intelligence does touch many parts of the economy, and that's a good thing. Again, I'm not opining whether or not we're in a bubble or not, but I think it is important to ask the question whether or not all of these billions of dollars that are being invested in artificial intelligence, and one company in particular at the top of that pyramid, obviously right now, is Nvidia, and whether or not we should be, as a nation, assigning so much value to what it is that Nvidia does. In fact, you could make the argument that the way our capital structure is turning out during this artificial intelligence age, in some ways you could argue that we are a managed socialist economy. And I know that might come as a shock to some people, but again, keep in mind the Asperger's in me. I'm seeing things other people aren't necessarily seeing. And if you think about communism and the way communist nations allocate capital to key industries, what you find is that that capital is allocated to a handful of companies. And the way we are evolving here in the United States, we have way more than just a handful of companies, so that's a good thing. But I think you see the greater point here that I'm trying to make, which is we are becoming a nation with a narrower and narrower set of winners in the economy. And I do think, again, without making any opinions or offering up any sort of remedies for this situation, I just want to make note that the situation exists. Why is that important? Because the rest of the market is looking at things like, are we in a bubble or are we not in a bubble? And by the rest of the market focused on that question, they're missing the greater point, and it opens the door for people like us here in the Fireside Trader to be able to exploit what is happening when the greater audience is paying attention to, are we in a bubble or are we not in a bubble? Case in point, I'm good friends with a very successful individual who has a managed account with Morgan Stanley. The conversation with these private wealth managers is to discuss the concentration of their wealth allocated to the stock market, specifically with respect to Nvidia. Well, guess what they're starting to talk about? Taking money off the table. They are talking about reducing their exposure to Nvidia. Now, whether that's because they believe Nvidia is in a bubble or not really is irrelevant. I think the discussion does start because they view Nvidia as being potentially in a bubble. Therefore, it makes sense to lock in profits and to diversify, if you will, their own investment into various other segments of the market. But it is absolutely true that something is happening. And this past week, Nvidia offered up spectacular earnings. And even as a fundamental value analyst, I'm looking at their earnings growth, their revenue growth, and the multiple that investors are currently paying for that growth. And I'm sitting there thinking, okay, this isn't a bubble by any stretch. And yet, after moving higher in after hours and pre-market trading, and for about an hour or two after Nvidia began trading the day after their earnings report, the stock was up some 5 or 6%, and all of a sudden, someone rang the bell and said, we need to be selling Nvidia, and shares plunged. The volatility that has caused because of the import and the size in the market of Nvidia has ramifications in the entire market economy. And it's fascinating to watch because, again, within that action, there are opportunities for us to trade intraday in pursuit of that 10% goal that we are looking to achieve as we build a portfolio to reach that $1 million goal. Now, there are a lot of traders out there talking on the internet, on YouTube, just like we're doing here today. They're talking about, hey, I built $1 million portfolio, or I built a $10 million portfolio trading this way, and you can do it too. That's not what the Fireside Trader is designed to do. I want to be your partner and talk about what we're going to do today and tomorrow, not talk about what we've done in the past. And so discussions around AI, like I've been having, are ways for me to understand the world that I'm operating in, the market that I'm trading in, and allows me then to find opportunities that we can exploit on a regular basis. So I do think, and if we can get a chart of Nvidia from the day after, you can see this volatility in Nvidia, and that action is creating a technical issue with the S&P and the Nasdaq trading, both of them now trading below their 50-day moving average. And if you look at a chart of the S&P 500 or the Nasdaq, and if you look at the 50-day or look at the S&P 500 vis-a-vis its 50-day moving average, and then put in the 100-day moving average as well as the 200-day moving average, you'll see that we have these big air pockets on a technical basis that should be cause for concern in the immediate term. This past week, in my daily trading service called the Opening Bell Arbitrage, we exploited the hope that was in the market, trying to get back above the 50-day moving average, realizing that that was not going to happen, putting in a short put spread on the S&P 500 to great effect, way above 10%. In fact, we went 5 for 5 this week in our trading, and it was really a wave, and I equate a lot of what I do in the market to surfing. And you can see with this new trend that is in place, we are firmly in a downward move. By the way, it's not a crash. It's not selling that is something that people should be concerned about. It's simply a long overdue pause and refresh and preparing to get ready for the next leg higher. And in fact, in my other trading service called 2 Sigma Trader, I am preparing for the bottom, which I believe will occur when we hit the 200-day moving average. That 200-day moving average is a very, very, very solid floor for the S&P 500 as well as the Nasdaq. And we are just in an air pocket here below the 50-day. It's likely that we're going to drift lower until I don't think the 100-day, by the way, a lot of people use the 100-day moving average. I don't. I don't think the moving average is anything but a paper floor, if you will, that doesn't provide a lot of comfort for me, at least, a trader. So I'm looking at the 200-day moving average on the S&P 500 as well as the Nasdaq to be my floor, and then I'm getting ready for that next move higher. Don't know when that's going to happen. Don't really care because, again, if you follow me in the opening bell arbitrage, you know that each and every day is a new day, that I triangulate a market scorecard, a proprietary market, gives me a forecast as to where the markets are going that given day, okay? And then from that data, I can triangulate a particular trade, again, in pursuit of that 10% goal that we are shooting for each and every day here in Fireside Trader. Okay, so that's the backdrop with artificial intelligence. I think the talk of a bubble is a distraction that you should put aside. Use the information, but don't get sucked into any of the narratives that are coming out of that quote-unquote bubble talk. I shared with you my thoughts on the S&P 500 vis-a-vis the technicals and the 50-day and 200-day moving averages, as well as the NASDAQ. The final topic I want to talk about, and this is an important topic because I think it is something that is potentially could be very damaging overall market. And I'm speaking specifically of a Bitcoin collapse. The bigger story in the market these last couple weeks has been the selling that is occurring in Bitcoin. The folks that follow Bitcoin closely are looking at various technical factors. I don't believe those technical factors have very much efficacy on such a nascent, brand spanking new security where we don't have a lot of history. Technicals are built on the power of history and data, tons of data collected over the years. You don't simply have that with respect to Bitcoin. So there's a lot of talk about, well, Bitcoin at $100,000 is the floor, and then we crash through that. Well, then the next step on the technicals is 80,000, and we traded briefly overnight. I believe it was on Wednesday or Thursday. We did get down to that $80,000 level coin on Bitcoin. The issue with Bitcoin, to me, is the company called Strategy, MS, is highly leveraged and obviously front and center for the Bitcoin and crypto revolution. They have borrowed heavily in the capital markets. There are convertible bonds that are out on the marketplace that Strategy is required to pay on. Now, those bonds that they issued, that they used the proceeds to buy Bitcoin, have certain covenants. And those covenants, I'm not sure the market understands exactly what those covenants are. Now, in the last year, Strategy has switched to an even dicier financing strategy using preferred stock as the security of choice to raise the capital that they are then using to buy Bitcoin. What I'm concerned about as somebody that spent years around the fixed income markets is that the potential for a default here is very real. And it's not necessarily a default in the sense that Strategy doesn't have the assets to pay the bondholders. What I'm worried about is that an event could trigger sales of Bitcoin that MicroStrategy, or now Strategy, is required to use to pay to convertible bond holders. And when those covenants kick in, or when those bonds are called at par, or Strategy being required to pay 100 cents on the dollar to those bondholders. Where are they going to get the capital to do that? Well, they're going to be required to sell if they don't have access to other instruments to raise money to pay off the bondholders, right? Then they're going to have to sell their Bitcoin. Now, this isn't something that they're going to have to do today. I believe the first bonds are convertible in 2027 and in 2028. So we're looking a bit down the future here. But what seems to be happening is the short sellers are circling around Strategy and could be putting the company in a very, very tight noose that requires to sell something they don't want to sell, which is their Bitcoin, and sell it, by the way, at a much lower price than the current 85,000 or whatever it's trading for as I record this. So you have a situation here where, again, I don't own Bitcoin. If I did, I would be very inclined to want to liquidate my position immediately. I mean, depending on my end, of course. Now, if I got into Bitcoin, even at $40,000, I'm still sitting on a double here, right? So you can see the mental gymnastics that folks who own Bitcoin at a lower price are going through right now. And that's causing what I would call a void of selling that could only get magnified if there are forced liquidations coming from Strategy on top of all of the selling that's already there. Now, the CEO of Strategy is out there defending the structure of the company and says it's perfectly fine, even if there's a 90% correction in Bitcoin. Well, okay, stop and think about what he's saying there. His company may be okay. He may be okay because I'm sure he's enriched himself. I know Wall Street has enriched itself by charging fees on the bonds, preferred stock that they're selling in this, for lack of a better word, Ponzi scheme, could have a real impact on the markets. And that impact could be way, way, way beyond the crypto stuff. What we could see here is again, forced liquidation of Bitcoin for those that borrowed money to buy Bitcoin, or companies like Strategy that, again, issued debt to buy Bitcoin. It's a risk. I'm not saying this is going to happen, but I'm saying this is very reminiscent of the convertible debt obligations that Wall Street issued during the housing crisis, and the short sellers went out and did credit default swaps where they were selling these CDOs short and they're not convertible, they're collateralized debt obligations. I said convertible. I apologize. It's collateralized debt obligations, CDOs, and they made a ton of money doing that. Now, the short interest in Strategy has been inching higher, nothing extreme, right around 10% of the float. But if we see that go significantly, I can tell you that bad things are going to happen to Strategy stock and to the ecosystem around. It is interesting for those that are fans of crypto. I am not. I will readily admit I don't get it. And that's okay because I'm an old guy. But I understand finance well enough to be what's going on here. I am intrigued by the idea of stable coins, and stable coins are buy something. See, Bitcoin is not. And then there's this other little risk with Bitcoin that I haven't even mentioned that's starting to get some run here in the financial press, and that is quantum computing. Developments in quantum computing could create a computer mano a mano, right? Where the quantum computer has the power, the crypto code that Bitcoin is written on. And I don't know, that's because Bitcoin isn't backed by anything, that just seems awfully dangerous, right? I get it. Defenders of Bitcoin are going to be sitting there saying, well, you just don't get it. Okay, I don't get it. Heard and followed Bitcoin really since Bitcoin was trading under $1,000. I think at the time I started writing articles about Bitcoin, the average price of $500. So I have followed the history closely and of what I speak, and I am concerned. Doesn't guarantee that it's going to happen, but I do think there is risk here for not only strategy, but also for a significant, beyond significant correction in Bitcoin prices. To me, that's a much, much bigger risk than what's happening in our intelligence. That is a much larger problem than what is happening in the AI space and Nvidia. Again, remember, the question that we should be asking about AI and Nvidia has to do with allocation of capital and concentration. And those are things that the markets are going to figure out over time. I don't think there's any risk of there being any sort of disaster there. There is a risk of a disaster with Bitcoin. So that's really all I wanted to share with you all today from the fireside here. And really, for the most part, just super excited to be with you at the beginning of this journey for $1 million portfolio. And we're going to just have a lot of fun doing it, and we're going to be jam-packed with content. And every week I'm going to be bringing you another fireside chat, talking about markets, talking about whatever happened in the week prior and what I'm looking for in the week ahead. And like I said, I am looking for a bottom here around the 200-day moving average for the S&P 500 and the Nasdaq. So we'll leave it at that. This is JD for Fireside Trader. Thank you for joining me on this inaugural episode, and I can't wait to see you in the next episode. Take care, everybody. Good luck with all of your trading, and we'll see you all next time.